Index funds are investment vehicles, either mutual funds or exchange-traded funds, ETFs, designed to replicate the performance of a specific stock market index, such as the S&P 500, FTSE 100, or MSCI World Index. These funds aim to mirror the composition and returns of the chosen index by investing in the same securities in the same proportions as the index. For example, an S&P 500 index fund will include stocks from the 500 companies that make up the S&P 500, weighted according to their market capitalization. Unlike actively managed funds, where a fund manager tries to outperform the market by selecting individual stocks or timing market movements, index funds are passively managed. This passive management means they follow a set formula to track the index without trying to beat it. This strategy leads to significantly lower operating costs because there's no need for extensive research, active decision-making, or frequent trading. Key features. 1. Diversification. Index funds automatically provide broad market exposure. By owning a single index fund, an investor gains access to a large number of stocks or bonds, reducing the risk associated with individual securities. 2. Cost efficiency. Since index funds do not require active management, their expense ratios, fees charged by the fund to cover management and administrative costs, are typically much lower than those of actively managed funds. Low fees mean more of the returns stay with the investor. 3. Performance. Historically, most actively managed funds fail to outperform their benchmark indices over the long term, especially after accounting for fees. Index funds, by design, deliver returns closely matching the index's performance, making them a reliable option for consistent market-matching returns. 4. Transparency. Because index funds are tied to specific indices, investors can easily understand what the fund holds and how it operates. The portfolio changes only when the underlying index changes. 5. Ease of investment. Index funds are widely available and can be purchased through brokerage accounts, retirement plans, or investment platforms. They are suitable for both beginners and seasoned investors. Example: an investor seeking exposure to large U.S. companies might invest in an S&P 500 index fund. The fund would own all 500 companies in the index, including major firms like Apple, Microsoft, and Amazon. As the S&P 500 grows over time, so does the value of the fund, minus small fees. Benefits: long-term wealth generation, mitigation of stock-picking risk, ideal for passive investment strategies. Risks: while index funds reduce individual stock risk, they are still exposed to market risk, meaning they will decline in value during market downturns. They are also limited by their strategy. Since they cannot outperform the index, their returns are capped by the index's performance. Overall, index funds are a popular, low-cost, and efficient way for investors to build wealth over time, especially for those following a buy-and-hold investment philosophy.